Welcome to some introductory material for our fraud examination course. The material that I have here is material that I've taken from my beginning auditing course. So if you've recently had that, you may be very up on this material. If not, you'll just want to go through this with me. It's not hard material. But the reason I want everybody to understand this material is because so much of what we cover in the fraud course is based on it. So what we'll do is go over some introductory material about internal control and about fraud. So let's look at internal control first. So here in the notes, which you should have in front of you, I have the first section about internal control and some components of the internal control structure. Well, a lot of this material was taken from an organization called the Committee of Sponsoring Organizations. The abbreviation is COSO, and they are a panel of blue ribbon experts who sit down and develop good standards for good internal control. There are other standards out there, but COSO is by far the most widely regarded in the profession. So if a company's internal control meets COSO standards, as every single publicly traded company that I'm familiar with does try to meet, well, then they're regarded as having great internal control. So let's look at what great internal control looks like. We're going to be referring to Table 11.1 in the auditing textbook to overview the 5 components of internal control which COSO has. So I will put those up on the screen in just a moment. You can stop your this video, or pause the video, I should say, and take a look at them. So 3 I'm going to look at from the table, and then 2 other components I'm going to elaborate on here in the notes. So the 3 components that we will take a look at just from the table will be the control environment, management risk assessment, and the accounting information and communication system. So let me turn over to the textbook and share that screen with you. There we go. So again, this is Table 11.1 on page 348 of the auditing textbook if you have it. Again, if you don't, simply pause the video and you can read this. So first of all, the control environment. So the control environment, a description of the component, the actions, policies, and procedures that reflect the overall attitude of top management, directors, and owners of an entity about internal control and its importance. Well, very often this is referred to as the tone at the top of the organization. So what kind of culture does top management have? For example, Florida Southern, we have very good culture, headed by the president and the board of trustees, which is the analog to the board of directors. So those at the top are very committed to having great internal control, etc. And it's principles that we want to see. On the part of those at the top, we want to see integrity and ethical values. We want to see the board of director and audit committee participation, the audit committee being a subset of the board of directors. And I'm on the audit committee at Florida Southern, so I help make sure that, yes, we've got great participation. The organizational structure, so that everybody knows what they should be doing. There should be an organizational chart, of course. Also, the top management is committed to competence and accountability. They hold people accountable for their actions. So it's just rather like on a sports team. That team is only as strong as the coach at the head of it. Same sort of thing here. Now, the second component is the risk assessment, which management needs to do on an ongoing basis so that they address any risks which face the organization. So looking at a description of that, management's identification and analysis of risks relevant to preparation of financial statements in accordance with appropriate accounting frameworks such as GAAP or IFRS, standing for International Financial Reporting Standards. So some principles would be that management would have clear objectives in order to identify risks relevant to those objectives. So for example, if there is information risk where somebody could hack in from the outside and steal information, management's constantly identified that. Then determine how those risks should be managed. So how can the organization have even better safeguards to guard against hacking, for example. Consider the potential for fraud and monitor changes. So if there is potential for fraud, and certainly hacking is a type of fraud, well, consider what might happen there and again address that. Now, as I come down to information communication system, I will also just discuss that from here in the book. So methods used to initiate, record, process, and report an entity's transaction, and to maintain accountability for related assets. So we're talking here really about the accounting system. So we would use relevant quality information to support the functioning of internal controls. So we make sure the information is of high quality. It is not fraudulent information. For example, if management will wish to increase sales revenue, perhaps they would use fraudulent sales to do so. That would not be relevant and quality information. Then communicate information internally, including objectives and responsibilities for internal control. And then communicate with external parties relevant information related to internal control as necessary. That would be under the accounting function again. Now, let me come to control activities. I will elaborate on these in the notes. So policies and procedures and management established to meet its objectives for financial reporting. And again, I'm going to elaborate on those things. Probably better off just to go straight to the notes here. So coming back here to the notes, number 4, as I have on my handout, control activities. Well, the client should have appropriate controls in place at each control point. A control point exists whenever unintentional error or fraud could occur, including recording transactions and safeguarding assets. For example, whenever cash is coming in or going out of the organization, that's a major control point. We want lots of internal control there because cash could be stolen. And also regarding cash transactions, there are a lot of them, and there could be innocent errors here too. The same thing applies with most inventory as it comes in and goes out of the organization. Plus, both cash and inventory, while the organization holds them, those need to be safeguarded as well because of things like theft. And also much inventory could be rendered damaged and obsolete because of damage. So we don't want that. So let's add the following. First of all, one major control activity here is separation or segregation duties. This comes up all the time with fraud. And basically, someone should not be placed in a position where they can pull something and cover it up. So commit fraud, cover it up, not good. And there should also be checks and balances to prevent and detect innocent errors. So as you can guess, fraud is intentional. Most things that occur in business are actually unintentional. Nobody meant to make a posting error, a mathematical error, or whatever it may be. Well, anyway, the following duties should be segregated or performed by different people. And the textbook didn't give a very clear breakdown. I do. So one thing that should be segregated, custody of an asset, such as the treasurer of the organization who has custody of cash, or someone under the treasurer, such as a cashier. We want that person separated from record keeping or accounting for the asset. The controller being the chief record keeper or chief accountant for the business, and under the controller could be someone such as an accounts receivable clerk who is recording cash receipts in accounts receivable as customers pay their accounts off. Well, we do not want the person who has custody of cash receipts to also be able to do record keeping for cash receipts. If they did, that one person could steal cash and cover it up in books. And that has happened many, many times, with usually in small business with an office manager who is doing both these plus other conflicting duties. The other thing that can happen, and it's always an inherent limitation of internal control, is that we could segregate these, but the one employee who has custody of cash gets together with the one employee who does record keeping. And the one having custody of cash steals some cash. The one doing record keeping covers it up in the books. and therefore they get by with it and split the proceeds. So collusion, such as that, is always an inherent limitation of internal control. Well, then something else we want to be separate, authorization of transactions pertaining to the asset. So let's say that we had someone with custody of cash, they keep the related records regarding cash, and they authorize cash disbursements. That could even range down to signing checks. Well, that person could certainly pay themselves and cover it up successfully. Then, internal verification pertaining to the asset. Internal verification means that somebody checks over everything they possibly can on an ongoing basis. A bank reconciliation for cash is a good example of that. Sometimes internal verification is not done effectively, or it's not done at all. For example, sometimes you may hear me talk about Payne Air Conditioning, a little bit north of Florida Southern. A few years ago, their office manager had all these duties combined, and she was stealing cash from the business, several $100,000 in fact, and she was using it for gambling. So she was taking the cash after work every day to a local convenience store across from the Lakeland Library on a side street and buying lottery tickets. She felt that if she did not buy lottery tickets that day, her numbers would come in. So that was the very voice of addiction. Well then, in some areas, operations or execution of transactions may also be a separate duty. And that means if we have, let's say, a separate sales staff, they are executing sales transactions, sales operations. We don't want them being able to get in and have conflicting duties. For example, if salespeople could also authorize credit or authorize commissions to themselves, well, suddenly their sales would go up and so would their commissions. And then information technology often leads to some duties being combined. I'm not going to worry about page 344, but one key control is to separate IT duties, such as access to software, from users outside IT who have operational responsibilities. Thus, no one employee should have IT duties and operational duties. For example, if we allowed the sales staff to get in to change software that controlled customer credit limits and controlled sales commissions, suddenly both customer credit limits and sales commissions would go up. So we always have a separate IT staff from the people who are doing day-to-day operations. Well then, as we look at B, here's something else we need. Authorization, either specific or general, or both for that matter. That means every transaction which takes place is authorized in some way. General authorization would be to authorize a general class of transactions, such as we accept MasterCard, Visa, American Express. And then specific authorization would be to get a credit approval number for an individual transaction. Then we also need adequate documents and records so that we document everything. One major problem that can exist in business is that not everything is documented. And today, the mantra is document, document, document. And I'm not concerned with the rest of that. Under C, coming to D, physical controls over assets and records. We need to lock them up, protect them from the elements, protect information from unauthorized access, such as by hackers. And then independent checks on performance, we always need those, really the same thing as internal verification. The last control component that is on that page is monitoring, and I really cover it better here in the notes, so I'm not going to go back to the page in the book for that. But COSO says a fifth control activity we must have is monitoring. It's to ensure that internal control is operating as intended, it's modified as appropriate. And that would be strengthened by an internal audit function. It's also a good type of internal verification in many circumstances. So instead of coming from the outside, an outside CPA firm that is, as external auditors would, internal auditors are employed by the company itself. And bringing on, also the size of the business often affects how formal the internal control system is. And for example, in an owner-operated firm, which is small, the owner's involvement is often a very good compensating control. Compensating control means that if at first it looks like we don't have good internal control, such as there's not good segregation of duties, well, in that case, we want to see the owner's involvement. Very good compensating control. So that more than makes up or compensates for the lack of segregation of duties. And we'll see some frauds in owner-operated companies during the course. The owner-operated companies are often small, so they may not have enough employees to segregate all the proper functions. And in that case, owner involvement is critically important. And the owner should also perform authorization and internal verification personally if possible. So sign the checks personally, do bank recs personally, and other sorts of internal verification if possible. By the way, it's also a good idea for the owner to open the mail and prevent customer payments from being stolen. Paying air conditioning, that's exactly what the fraudster did. She deposited those into an account at SunTrust, which she had set up, which sounded rather like the business name. But the business itself used Bank of America. So she treated that SunTrust account like her own private account. Now, as we come down to the next section, some conditions for fraud. First of all, as we said, fraud is intentional. And in fact, is any intentional deceit meant to deprive a party, another party, of its property or rights? And in accounting, fraud could involve fraudulent financial reporting, misappropriation of assets, and I wish that we had more time during the course to get into information fraud and also consumer fraud. We'll get into those a little bit. Now, on page 299, there's something called the fraud triangle. It is in the Albrecht textbook. It's also in the auditing textbook. And I will show you that here. Come to that, as you see on your screen, from the auditing textbook. By the way, Albert Cressy was not an accountant. He was actually a criminologist, but very, very useful fraud triangle that he came up with. So he says that for fraud to occur, there must be some incentives or pressures, such as the fraudster paying air conditioning. By the way, her name was Judy Holter. She's in prison right now. She had the incentive for gambling. She was addicted. Opportunities. She did everything within the company, essentially, as the office manager, and the manager was not looking over her shoulder. He did not do internal verification. He did not open the mail with customer payments. Then attitudes, rationalization. Well, she said that if she did not play the lottery that day, that she was afraid that her numbers would come in. So the voice of addiction. By the way, she thought that she would eventually put the money back in paying air conditioning. But once a fraudster starts going, the underlying incentive or pressure is still there, like her gambling addiction. At one time, she won about $75,000 in the lottery, but she did not put it back as she thought. Instead, she just gambled it away. Very typical of a fraudster, I'm afraid. Well, coming back here to some conditions for fraud. Well, again, incentive or pressure, opportunities, and rationalization or attitudes. And attitudes include one's character or set of ethical values. And often people are often in environments which pressure them to rationalize fraud. And we can see examples of these fraud risk factors in two tables in the book, and I will show you. Pages 300 and 302. And also 301 portrays some of the most commonly cited fraud conditions. So let me go over to these pages. And again, you can pause the recording and take a closer look at them. So here on page 300, Table 10.1, examples of fraud risk factors and fraudulent financial reporting. That means where management has deliberately misstated the financial statements. So they've cooked the books. So again, you can pause and take a look here. Then on page 301, or I should go to 302 first. Let me do that. So rather a continuation of this. Examples of risk factors for misappropriation of assets. So in the previous table, that was about management fraud or how the management can deliberately misstate financial statements. This table is about employee fraud because an individual employee has a motivation to steal assets or misappropriate them. Same thing. So I will let you pause if you'd like to read this. Oops. And there's everything for you. Then going back to 301. Some of the most commonly cited fraud risk conditions, just like this one, because I can. So here are some pressure, some incentives to commit fraud. Again, I will let you pause and take a look at that. Then, number 5, there are also some interesting characteristics of fraud perpetrators. In table 10.3 on page 301, let me go back and take a look at that. Figure 10.3, characteristics of fraud perpetrators. It comes from a study from KPMG. So have a look at that, again, by pausing if you would like. Then, assessing the risk of fraud. Most stuff in here I can skip because it's geared toward auditing. Then corporate governance oversight to reduce fraud risks here in Roman numeral 4. Well, management is responsible for preventing and detecting fraud within the organization. It's always up to them. And of course, it's more effective to focus on fraud prevention and deterrence than to have fraud happen then try to clean it up later. Management should implement anti-fraud programs and controls to reduce fraud opportunities. Management should also communicate fraud detection and punishment policies to deter employees from committing fraud. Then B, management should also promote a culture of honesty and high ethics. So that corporate culture is very, very important. And the most effective way to prevent and deter fraud is to implement anti-fraud programs and controls, which are based on core values embraced by the organization. These reinforce acceptable behavior and expectations, which employees can use to guide their actions. And creating a culture of honesty and high ethics includes, well, first setting the tone at the top so that it's very good. And then number 2, creating a positive workplace environment to try to prevent fraud. And that includes a whistleblowing process, which is where if somebody knows something's wrong, they can let somebody in charge know on an anonymous basis. Then also hiring and promoting appropriate employees, doing background checks, etc. Having sufficient training of employees, periodic confirmations for employees that they've done no fraud, and also discipline if necessary. Then C, management is also responsible for evaluating fraud risks on an ongoing basis. And that includes taking steps to reduce identified risks, such as information risks and by hacking, as well as monitoring internal control, which helps to prevent and detect fraud. And fraud cannot occur without a perceived opportunity to commit it and to conceal it. So management should do some of the following. One is to identify and measure fraud risks. And management needs to recognize that fraud is possible and could be committed by virtually all employees. And we'll take a look at figure 10.6 on 310 for the impact of anti-fraud controls on fraud deterrence. Let me go ahead and flash that up here on my screen for you. So here in the figure, we see impact of anti-fraud controls on fraud deterrence. Just have a look at that there. When you have a chance, you can pause. And we see this came from the Association of Certified Fraud Examiners. And their website is very, very good to look at. Strongly encourage you to do so. And back with the notes. Well, we also need management to mitigate these fraud risks, address them as best they can, hopefully with good internal control so the fraud doesn't happen. Management also needs to, number 3, monitor fraud prevention programs and controls, and that's particularly important for areas with high fraud risks, such as cash. And that can be assisted by an internal auditing function. So internal auditors, cash is definitely one thing they monitor carefully. Then number 4, we also need audit committee oversight. And the audit committee has responsibilities for overseeing the organization's financial reporting and internal control processes. It should also consider the potential for management's override of internal control. That's another inherent limitation of internal control. Management, if we get to a high enough level of position, can always override internal control by taking advantage of that position, doing things that a lower level employee could not. D, I'm not going to worry about. That's really for my auditing class. Let's come down to Roman numeral 5, some specific fraud risk areas. First of all, with revenue and accounts receivable. Well, management has a motivation to overstate both. Revenue, overstating that would also overstate income. Management always has that motivation. And accounts receivable, overstate that, overstate assets. In other words, management also has that motivation too. And more than half of financial statement frauds involve this area. And also, since sales are often for cash or quickly converted to cash, cash is also highly susceptible to theft. So cash is right in here. Revenue is the largest account on the income statement. A misstatement in it involving only a small percentage of revenue can have a large effect on income. And revenue growth is also a key performance indicator the analysts and investors look at. So that's another reason management always has motivation to overstate revenue. And the timing of revenue recognition is often subjective. Also prevents an opportunity for fraud because management would like to step up the timing of revenue recognition if possible. Record it too early. So auditors always need to be on the lookout for these things. Very common. First of all, fictitious revenues. Just trying to inflate revenue, such as through fictitious sales. And number 2, premature revenue recognition. Again, trying to step it up too much. Then number 3, manipulations of adjustments to revenue. Adjusting entries, trying to increase revenue. Then number 4, stealing cash receipts involving revenue, including failure to record a sale and theft of the cash receipts after the sale is recorded. And the latter may also include recording a sales return or allowance, so acting as though the customer returned something what they didn't, or writing off a customer's account receivable, acting like it's a bad debt, or lapping, which is where an employee steals a Monday cash receipt, let's say from a customer, pockets it, uses the Tuesday customer's cash receipt to credit the Monday customer's account, and on it goes. Usually results only if we have poor segregation of duties between custody of cash receipts and record keeping for them. I'm not worried about the analytical procedures there. Coming to B, with inventory, management has a motivation to overstate inventory. It's an asset. And fraudulent financial reporting for inventory often involves fictitious inventory, especially at multiple locations. And don't worry about the rest of that. Coming to accounts payable, management has the motivation to understate accounts payable. A liability here, management always has the motivation to understate liabilities. And this can happen by not recording accounts payable increases until the next fiscal year. So instead of stepping them up, as with revenue, pushing them back, delaying recording them. Also, by recording fictitious reductions to accounts payable, like a fictitious payment of a payable. And also a common employee fraud involves issuing payments to fictitious vendors and depositing the cash into a fictitious account. And at Paint Air Conditioning, some of that went on too. One control that a company always needs to have is to have a list of authorized vendors and only do business with them. If someone wants to do business with another vendor, that needs to be pre-approved. Otherwise, you might have some fictitious vendors there in that list. Then fixed assets, things like machines. Well, these are large amounts with rather subjective valuations sometimes. They can be a tempting area to manipulate fraudulently. Management would love to overstate them because, after all, they are assets. One way is that management may capitalize or record as an asset repairs or other operating expenses, just as fixed assets. And fixed assets are often targets for theft because of their value and saleability, especially for assets which are portable, such as laptop computers. And such assets should be engraved and inventoried. Intangible assets, things like goodwill, well, not too worried about them, but they're based on accounting estimates. Their valuations may be subject to valuations by management. Management may therefore like to inflate them, overstate them. And then payroll expenses. Well, sometimes management can record excess payroll expenses inventory. And also sometimes fictitious employees can be created, or individual employee payroll hours could be inflated. That last sentence usually describes employee fraud. Somebody's trying to take home an extra paycheck. Let's see, is there anything here? Last thing, on page 319, figure 10.8. Let me flash it up on the screen. There are some interesting fraud detection methods here. Again, coming from the auditing textbook. Go. So fraud detection methods, we see the most effective one is actually a tip. So if somebody tips someone off, and that's one reason why there should be an honest whistleblowing process within an organization. So have a look at this when you have a chance. And again, we see this came from the Association of Certified Fraud Examiners. So that's the information I wanted to share with you. And please let me know, as always, if you have any questions. I'm always happy to help. Thank you.